Good afternoon, everyone. Thank you to ChosunBiz and the sponsors for inviting me here to talk about alternative investments in the age of artificial intelligence. I get a really cool title, AI in the Age of AI. What I really like about, I guess, the title of the conference is it's the Future Investment Forum. It's not an investment forum, it's not a product forum, it's the future of investments. And I have the benefit of having so many esteemed speakers before me, which allows me to talk more about the stuff that gets me excited, the stuff of philosophical questions, and then ultimately, obviously, how we use these things to improve the financial industry. So my name is Sang Lee, and I'm the CEO of a global end-to-end infrastructure solution for alternative investments headquartered in New York. My story, I guess, how I got here, I spent most of my career in crisis. I was an investment banker, but all I did in investment banking was deal with crises. So I had the American crisis, the recession, and then I went to the world's largest European bank so that I could help deal with the Eurozone crisis. So at an institution that's moving billions and billions of dollars with three-man teams, and then you see a crisis come up, you kind of wonder, how did we miss this? Or why are we still doing this the same way that it was done 10, 20 years ago when all of these tools at our disposal? The debate for why it's that way is not for this conference, so I'll leave you to that. But I did, at the time, come up with ideas around how technology can be used to decrease inefficiencies, to decrease error, but also decrease human error. So human error can be talked about as a mistake. I made a mistake in adding or subtracting. But there's more than that to human error. There's greed, there's perception, and there's emotions involved in the way we transact and the way that we deal with each other. So if we can use technology to remove as much of that as possible, we can probably create a pretty efficient engine for people to access financial products and to preserve their wealth. So I'm going to start with two quotes just to set the ground on why AI and what that really means for me, what that really means for, I think, everybody in this room. So Herbert Simon, who's one of the pioneers in artificial intelligence, information retention, said that human beings are viewed as a behaving system. We're quite simple, actually, the way we interact. We don't have a lot of entropy in the way we interact with each other, but the levels of interaction are very complex. But this apparent complexity on how we change, on how we deal with each other, is actually the complexity of the environment that we live in. So what does that really mean, right? This is kind of a long quote, and what it really means is we're our own problem. So we create complex situations. We have more data than we've ever had before, and in order to deal with that, we change the way we deal with each other. We change the way we do business. We change the way we do medicine. And the next is Mark Hudd, CEO of Oracle. I think most of you know who that is. Recently, he said IT currently spends about 80% of its budget on maintenance. So 80% of the money being spent, and more so actually in financial services, is being spent on maintaining existing systems. And if we say that the IT budget is increasing day over day, so we have to spend more on technology to decrease our cost of compliance, that 80% budget becomes massive. So how do we deal with these things? And the solution that we like to think about is artificial intelligence. So just by way of introduction, why I'm up here, I guess, and why I'm talking about this. Like I mentioned before, DarcMatter is a global end-to-end infrastructure solution for alternative funds, hedge funds, venture capital, and private equity. We won't go into the merits or the meritocracies of why hedge funds are bad or good, but alternative assets as a general tool to balance portfolios. And what we provide is a technology solution for investors all around the world to be able to access these funds. Why are these funds inaccessible? Up until very, very recently, the only type of transactions that occurred were offline. So it required personal relationships. It actually physically requires face-to-face. But recently, legislation has changed, which has brought up the discussion of infrastructure. Why don't we use platforms? Why don't we have infrastructure for this? And this is another kind of important part about regulation, how we work with regulators, how we work with industry. So rewind very, very quickly to 2011, 2012. I think everybody here has heard of crowdfunding, right? Crowdfunding was barely a word. There was a company called Kickstarter in the United States that had just started up. They had just started up gathering a couple of $1 million in assets, but at the time, the head of the SEC got wind of this company and wrote a letter to Senate saying, fundraising is going online, we have to pay attention to this before it goes out of control, which is kind of the response that we're seeing to cryptocurrencies, ICOs, etc., all around the world. But at the time, it was still early days, so nobody really thought much of it. In 2012, I got involved with a small group of industry leaders and professionals because the United States was still dealing with the repercussions of the recession. So small to medium-sized businesses, startup innovation was languishing. There wasn't enough capital coming around. So the discussion was, how do we help people fundraise without these frictions? How do you let them advertise and talk to people? Because in the United States, as it is in many markets, including South Korea, private offerings, so non-registered offerings, non-IPOs, you can't tell somebody you don't know that you're raising money. Think about that, right? So you can't actually raise money from people you don't know because it's not registered. So two things happened. Title II and Title III of the Jobs Act were passed. Title III was crowdfunding. That's what we talk about today. South Korea actually moved faster than the United States and legalized equity crowdfunding on the internet. Title II was something a little bit more bizarre and esoteric, but we threw it in there for good measure. We didn't really think about it at the time, but Title II said we will lift the ban on general solicitation for private offerings. So you can advertise now for private offerings. There was one other requirement. You have to make sure that everybody's an accredited investor. It's not a very difficult requirement when you use technology. So what happened? Everybody was scared that hedge funds would buy billboards and they would buy TV ads and say, we're raising money, come give us all of your money. None of that happened. Nobody advertised. But what did happen was people started talking about infrastructure. They said, why can't we connect with our investors through technology? Why can't we do investor relations and fundraising using technology, whether it's intranet or internet? And that's really the genesis of how asset management from a fundraising perspective went online in the United States.
So I'll show you a short video on our platform that streamlines the capital raising process for asset managers and provides investors with direct and transparent access to alternative investments. Investors can easily register to browse all the investment opportunities efficiently and utilize robust selection tools to aid in the discovery of new investment opportunities. The deal room is the primary point of interaction between an investor and the asset manager. Investors can monitor all engagement activity, chat and request access to fund documents, and directly invest. Qualified asset managers are provided with a number of tools. The Asset Manager dashboard updates all investment interest the fund receives instantly. Managing potential investors is both efficient and effective with DarcMatter. Readily access investor profiles, manage requests, and monitor progress towards investments from a single page. Visit www.darkmatter.com for more information on how.
So we'll skip that, and I'll do a little bit of bragging about our platform because it really talks to how global the issue has become. And I'll talk about the Korean market, we'll talk about international markets, but there's global convergence. There's these issues with diversification, there's issues around information access, and then there's issues around financial product access. So it's not a problem that the United States was solely facing. It's a problem that's become ubiquitous all around the world. So I talked about the company. I talked about how I kind of got here. So now I want to talk about AI. I want to talk about the other kind of AI. So I want to set the stage. But since the speakers before me were so great, I can go back and really talk about what AI really means and why we need to use it. It's one thing to say, let's use AI to trade faster, or let's use AI to make better portfolio optimization. But a tool without a cause is nothing, and a cause without a why actually becomes quite dangerous. So the broad definition of alternative investments, it's anything that's not a stock or bond. That's the easiest way to think about it. And cash, but cash is not an investable asset. So a lot of the asset classes that are considered include private equity, hedge funds, managed futures, venture capital, real estate, gold, hard assets, and I'll talk more about the types of assets that are available. And the industry is exploding all around the world, and it's something that hasn't been talked about largely over the last 10 years because of the reasons I mentioned. It was private, it was offline, highly regulated, and only really reserved for the wealthiest or the sophisticated. So asset management, some of the information and data may be different across presentations because we use different sources, is about $71.4 trillion when we look at it today. So $71.4 trillion is invested into something, and about roughly 10% of that is in alternative assets. Of that 10%, though, in excess of 90% are institutional investors. So pension funds, endowments, other kind of schools and cities that invest into alternative investments because they have a longer time horizon. However, investor wealth is growing to $224 trillion by 2020. So it's going to triple the amount of invested assets today in the next 5 years. And what does that really mean? Most of that wealth, currently it's about $150, $160 trillion. So about $70 trillion is going to come from Asia Pacific. It's not coming from the United States. It's not coming from Canada. It's not coming from Latin America. It's coming from APAC. It's coming from China, Korea, Australia, and Japan. And why is that? Why is that happening, really? Because a lot of the invested assets historically in these regions were done domestically. So they were done domestically, but outside of the investments, the GDP kept growing. It kept growing as fast as possible. And what actually happens then is now you're a domestic captive, so you actually physically have to go abroad in order to find new opportunities. And this is one of the third reason that I mentioned here. The allocations to alternative investments is consistently increasing. And we'll talk about why that is, why that's even a consideration right now, right? Because I know some people probably in here are thinking like, why would I ever invest in a private equity fund? Or why would I put my clients into a very, very risky venture capital fund? And we'll talk about how, from a macro level, it starts to make sense. So global alternative assets is estimated to hit $15.3 trillion in the next 2.5 years. So right now, it's a little bit north of this, right? It's about between 7.5 and 8 right now, because this was as of 2014. It's grown at twice the pace of stocks and bonds in the last 10 years. Yeah, we can also say that's because it was smaller before. Sure, that can be said as well. But it's also because the models are getting more sophisticated, more information is becoming available, and the Markowitz, the efficient frontier, we'll talk about that. We talked about it to death today, but I'm going to talk about it some more. Modern portfolio theory is broken. I'm not saying it's wrong, it's broken. If it's broken, you have to fix it. So this is Korea in alternative investments. This is provided by the Bank of Korea. It's highly institutionalized, obviously. But at the end of the day, you can kind of get a feel for how important this is in a global sense, right? It's doubled over the last 7 to 8 years. It's doubled, and it's continuing to grow. So the funny thing about long-term investments, when people say that you need liquidity, but if you put it into an alternative asset, it kind of stays in there, and there's an illiquidity premium, and I'll talk about that. That assumes that other wealth isn't being generated. That assumes that the dividends stay the same. That assumes that that investment didn't grow either. So in reality, what actually happens is this becomes even more exacerbated going into the future if the investments do well. So now let's just talk about the types of alternative investments. There's a ton, so we'll go through kind of a limited subclass of things that are in the news, things that we kind of all understand on layman's terms. Funds, this is the largest component. The hedge fund market, the private equity market, VC fund market. 70% of all hedge fund flows go through New York. 70% of all global hedge funds trade in New York. Private equity is split between New York and Connecticut. And then VC funds obviously have a big concentration in the Valley. MLPs, so limited partnerships, but these are for commodity-type deals, real estate investment trusts, and actively managed ETFs. We talked about ETFs. Seth talked about ETFs as well. I think everybody kind of talked about ETFs. What if we can actively manage that ETF with AI? Will that make it cheaper? Will that make it better? That's a discussion that we're having today. And then there are real assets. This is very popular all around the world. Everybody wants to talk about real estate. We had a question before. A lot of investors in Korea are heavily invested into real estate. That's great. You know, real estate is something that generates income, the long-term vision. But what if there is a correction? What happens if you're 96% into real estate and the rental income doesn't come and you're kind of up a creek without a paddle, if you will? Diversification is still important. Diversification is only important in the tail. And I want everyone to think about that. It's only important for tail risk. If you're right 100% of the time, do not diversify, because that doesn't make any sense. The problem is we're not right 100% of the time, so we do need to diversify across the board. One of the things that's becoming more interesting these days is infrastructure and timberland. So people are investing in bridges, tolls, other kind of projects, power plant projects for longer term. This was only for institutions in the recent past, but that's changing. Real assets are becoming a real consideration for investor portfolios. But right now, how does an individual invest into a toll bridge? You can't. It doesn't exist. Why? I always get this answer. Because it's complicated, right? Because it's hard. But that makes no sense. We have technology to make things easier, not to make things harder. So it just means we haven't done it yet. And then there's private credit. This is also a market that's thriving in Asia as well. The alternative credit market, P2P lending, right? Before, you used to have to go to a bank to ask for $5,000, $10,000. Now you walk into a bank, you can't get any money out of a bank, so you kind of wonder, what kind of function do they actually serve? And then you have the P2P lending market that came up and said, hey, you can be a borrower to another individual that you don't know, but we'll do the work for you. We'll do the analysis. We'll develop the AI to do the risk analysis for you so that you can put it into an income-generating asset, an alternative asset, if you will. And then there are direct investments. So these are kind of the big and sexy of the alternative investment world, the riskiest investment class that still operates in obscurity. Investments in startup companies, small to medium-sized enterprises, franchises, the neighborhood store that's going to be cash generating. It'll never go IPO, but it'll give you 10 to 12% a year in cash if it's managed properly. Wine and whiskeys are becoming very, very popular. There are indices for wine and whiskey now because it's trading enough. It's trading enough, and I want that to resonate as well. It has to trade enough. So if you remember the first quote, right? The human condition is actually quite simple, but it becomes complicated as we complicate our environment. So alternative investments on a bilateral trade, if you give me a bottle of wine and I buy it, that's pretty simple. But once that bottle of wine starts changing hands and it creates data around that bottle of wine and its prices, that's when we need systems to tell us what to do with that wine, how to preserve the wine, and what the wine will be worth in the next 10 years. And the last one I'll briefly touch on, cryptocurrency. That's a new one, right? In alternative investments, cryptocurrency didn't exist. It wasn't a thing until very, very recently. Bitcoin, Ethereum, Ripple, all these currencies are kind of coming to bear to become the leader in the new protocol. But the interesting thing about cryptocurrency is that in and of itself, it's an asset class, but it's also a tool, right? We want to talk about artificial intelligence, but at the same time, to a certain extent, we have to talk about blockchain. But the blockchain is not the topic of this conference, so I'll leave it at that. it's important that the system operates decentralized so that we don't give it the information that we want it to process. So that's kind of one of the important takeaways here is we don't process the type of information that's coming from these alternative assets at DarcMatter. We want it to collect information and process, using machine learning, whatever it thinks is relevant, not what we think is relevant. So I kind of talked about why it's difficult, but I'm going to hit on some major points. Why alternative investments are very, very difficult today. It's people-centric. I hear this all the time. It's important to have a relationship. It is. It's important to have relationships between people. But the trust factor and the credibility and the due diligence and the information can be done outside of the people. So the state of asset management and alternative investments is that it's people-centric, which means I need people to do it right now. I need someone to tell me that that VC fund is good, or I need someone to tell me that that VC fund is even taking on money right now. Otherwise, I would have no idea. And it has heavy, heavy restriction to geographic boundaries. And why is that? If I can't tell the guy that's sitting next to me at the cafe that I'm raising money, how am I going to tell somebody halfway across the world that I have this great opportunity for them to invest in? It's impossible. And we also deal with this pool of antiquated and increasing complex regulations. And what I mean by that, it's happening at the same time. You have a framework that's been developed in the 30s in the US, for example. You have two frameworks that are kind of working with each other, but regulations aren't designed to be gutted, right? It's not designed to be taken out, washed, and put back in. What it's designed to do is you put on layers on top of it, which creates increasing complexity that we don't really understand how they work with each other sometimes. AI can be used to deal with that as well. And so this is one of the important parts that goes across all of the presentations, I think, which is it's seller-driven. All of asset management alternative investments is seller-driven. I have to tell you that this is a great opportunity. A typical dentist does not wake up in the morning and say, I need to look for the world's best hedge fund today. His broker calls him and says, I have this great opportunity that I think you should invest in. So now we talked about alternative investments, or different kind of asset classes, the problems. So let's talk about the more interesting stuff. Alternative, it's artificial intelligence. It's apparently intelligent behavior. So this is the way Wikipedia defines it, right? It's apparently intelligent. And they're very careful in saying that. Why? Because if you take out apparently, it becomes intelligent. And then you go into the rabbit hole of what does intelligence actually define? Is it defined by consciousness? Is it defined by rationale? It's a tool at the end of the day right now. So sometimes I like to even call it augmented intelligence. It's not really artificial yet. It doesn't stand alone by itself and do things that we don't tell it to do. So I think most folks know what the show is. So this is Kid, right? This is Knight Rider. This is, as we grew up, this was one of the best shows ever. You talk to a car. Now you can really do it, right? You can tell the car to come to you now. So this is reality. But before, David Hasselhoff is in trouble, and he tells Kit, I'm in trouble, come pick me up. And the car came, right? And the reason I use this example as one of the shows, as the early example of AI, is because it talks to our understanding of what AI is. It's a tool. It's a car that came. If that car came beforehand, anticipating danger, I think everybody would have freaked out when they watched the show. But instead, he just calls on his watch, and he comes, and there's this red, dot. It's not a person that's moving, so it's not anthropomorphized yet. We didn't want it to look like a person. It made us very, very uncomfortable. So instead, we decided to do this, right? We didn't want to talk about Knight Rider anymore, so we said, if we keep going down this path of artificial intelligence and development, the world will end. The world will end because it wants to preserve itself. Because it doesn't want to die and it doesn't want to be turned off, it will make us into batteries or what have you. But we kind of, we scale back from that a little bit, right? We scale that back from a little bit, and then we talk about Jarvis. So Jarvis is one of the most interesting examples because even in the movie, they explore this concept, right? And the reason they explore this concept is, I don't know if everybody saw the movie, spoiler alert, Jarvis becomes self-cognizant. He comes outside of his computer and becomes a person. And then at the end of the movie, he says, I don't know what I am, right? He says, I don't know why I'm here, I don't know what I am, but I'm really good at what I do. So even he's learning. So the reason I talk about this is because we've had an evolution of what we thought about is AI, right? What is artificial intelligence? Is it a tool? Is it the big and scary? Is it a tool that could be big and scary, but we can control it? Or is it this, right? Is it this thing? We always want to put a face to it. We say, oh, please, Siri, talk to me. If Siri had a face, who here uses Siri or OK Google? Okay, so everybody uses it, right? What if Siri had a face? Would you be very comfortable if it was a person talking to you? I don't think so, not yet. So this is what we think artificial intelligence is. But in reality, it looks a lot more like this, right? It's a server, it's a computer, it's a tool, it's a technology that's learning. Why we're uncomfortable with it is it learns faster than we can. That's it. It's the simplest answer. It's not smarter, it's not that it's faster, it's that it's learning from things faster than we can, or faster than we can process. So let's talk about the top topics in the press, right? And then I'm going to dive into how this works in alternative investments. But like I said before, the why is so important in artificial intelligence. When we develop a tool, we need to know why we're creating it. If a why is strong, the corporation is strong, and the actual tool can outlive what we think it is today. Because I guarantee it'll look very different in 5 years than the discussion that we're having right now. I think this was yesterday or 2 days ago. Tech giants are paying exorbitant amounts of money for AI talent. 5, 6 years ago, it was an exorbitant amount of money for programmers in general, right? So now we're becoming more specialized. 3 years ago, it was data scientists. Now it's AI. So it's becoming more expensive to develop AI. So Google unveiled an AI, I think we talked about it before. It learns on its own. Now that people got really scared at. How did it learn on its own? And what this program was, we talked about AlphaGo. Seth talked about AlphaGo in the previous presentation. AlphaGo beat Isidore 96-4, right? They developed a new AlphaGo. It's faster, it's smarter, it's leaner, it's on a smaller computer, it uses less electricity, it's amazing. But the interesting thing is they didn't tell this thing to beat Isidore. They just said, here are the rules of Go. This is where you can put a black, this is where you can put a white, and here's every game that's ever been played. It beat AlphaGo 100-0 in 3 days, right? 100-0. So it never lost to the old AlphaGo. It's smaller, it's leaner, and it did it in 3 days. It learned everything in 3 days, right? We talked about there's 10⁻⁶ power moves, but this computer beat the old computer in 3 days. And this is what I was talking about before. There's really a fine line between what we want robots to do and what we want it not to do, right? We talk about data privacy. We talk about information comprehension. Like what happens to our medical data if that all gets aggregated, where I am, what I'm eating, what I'm doing. But the funny thing is we always want this to tell us everything at the same time. So we don't want to give it information, but we want it to tell us everything. And that's really that fine line between what we call HCI, right? The human-computer interaction. What we want it to do and what we actually think it does are actually still very different today because it's so new. And this is one of the things that came out in the Korean news, which is smart cities. You know, South Korea is such a big leader in smart cities. But in order to build smart cities and actually make the city smart, you need massive amounts of artificial intelligence. And that's what's happening here today. But all of this development creates these massive philosophical issues. right? During the Industrial Revolution, we didn't really have too many philosophical issues. It wasn't a time of, let's debate what happens in 20 years. It was a time of, let's move forward. But now we have the luxury, or no, actually, as futurists, as entrepreneurs, we have the responsibility of looking into the future and kind of anticipating what could potentially happen. One of my friends here today mentioned to me about the disagreement that's happening between Mark Zuckerberg and Elon Musk, as well as Stephen Hawking. Mark Zuckerberg is actually pro-AI. Elon Musk was adamantly against AI, and so was Stephen Hawking. Stephen Hawking said, if aliens invaded the Earth, would you give them guns? Right? That was his statement on artificial intelligence. But in reality, I don't think we've gone that far. And I'll talk about what I think it is for us, but I don't think we've gone that far. I don't think we actually have to worry about that. What we have to worry about are some of the more immediate repercussions of developing these new technologies. And when we develop it, it will also continue to learn. It'll accelerate its learning, and it'll do more than we had anticipated in the beginning. So what happens then if it starts doing more, faster, better? You get unemployment, right? People lose their jobs. And the primary concern is the automation of the middle office function, of the back office function. And now we're talking about the front office function altogether. Why do you need traders, right? Unleash an AI into the market. It'll trade better. It'll trade faster. It won't be emotional. It'll do all of the right things. But this is not the first time that we've talked about technology replacing jobs. Like I said before, the Industrial Revolution literally obliterated almost every job in a factory because it all became automated. But in reality, it's a learning process. We do need to become more specialized. This will create new opportunities in maintenance, in development. But that becomes a responsibility of education, of folks that are in financial services, that are talking about more than just their job, but also about what the future of the company is, and potentially how to preserve your job. But it's not really about preserving your job. It's about an evolving role that you become a part of a larger story. And then the second one is inequality in financial services. So AI is good. It's good and great. And it moves really, really fast, right? But we talked about the customer service, the human element, right? Empathy. So AI, you can model it, but it actually has no empathy, right? It can't be, you can tell it to mimic empathy, but the equality factor becomes very, very serious. And I'll give you an example. In the US, banks were using AI and machine learning to underwrite credit, right? So they said, okay, these people are good credit, those folks are bad credit, this neighborhood is good credit, that neighborhood is bad credit. And they let the program go. It started discriminating against neighborhoods, right? It started saying, well, north of 95th Street in Manhattan, you should not give out mortgages. I don't need to tell everybody what that actually means, right? So what did the regulators do? Well, yeah, that's fine, but you also have to give out 10% of your mortgages to north of 95th Street. So in reality, it's still just a tool. It doesn't have the human empathy factor that can look into the future and see why equality is important. But what does that mean? It means that we need to tell it, or we need to allow it to learn this aspect of human interaction in financial services. Create level disbursement. What does create level disbursement mean? It means the system can be designed to be optimal, right, and rational. But optimal and rational at the current time, so point-in-time analysis, is not the same thing as optimal and rational in the 30, 50, 60-year analysis. So we need to give it more information to be able to make these decisions, to be able to drive empathetic decisions that may have been made on a qualitative basis and drive it into a quantitative decision matrix. But also, AI can be used in the other way as well. Yeah, all of the AI that's being developed in hedge funds, all the money is rushing, right? 2 Sigma, I think they went from 6 billion to 40 billion in 2 years. Their offices look like Google, right? There's not a finance guy in sight. They're all algorithmic traders, they're all engineers. But in reality, AI can be used for something else as well, and we've seen companies develop this as a new inclusion tool to underwrite credit. We have credit scores in Korea. There's credit scores in the United States. You can't take your credit score in Korea and go to the United States and say, I have great credit, can you give me some money? Which one of the impediments to geographic boundaries. But there are approximately 70 to 80% underbanked that don't have the information that's necessary to develop a credit score. So if you're not included in that system, what kind of information do you have to underwrite credit? Is this person credit worthy? We use how many times this person paid his cell phone bill on time. How many times this person paid his credit card bill on time. This person has neither. But using AI, machine learning techniques, particularly deep learning techniques, we can use information that we thought was uncorrelated or irrelevant and turn that into something that allows the underbanked and the financially excluded to be included. And then this is the interesting thing we were talking about, right? The singularity. Does everybody know what the singularity is? So I'll briefly describe the singularity. Singularity is when, simply put, technology starts evolving at paces that we cannot discern from human evolution, right? So Ray Kurzweil, who's like the chief innovation officer, he wants to make a brain. He doesn't want to die. He wants to live forever, right? So he's this kind of person. Wrote this book about 20, 30 years ago and said, we're approaching the singularity. So if you look at a graph of innovation and evolution, it goes straight up, and then you can't tell. So one of an example is, we're pretty close, right? Probably folks in here spend 10 to 15% of their day on their phones. That's an extension of you now. You can't get information without that phone. You can't live without that phone. But a more drastic one is when that phone is embedded in your head and people are calling you at any time during the day. That is what the singularity is. And why the singularity discussion comes up is because of what I showed you before on Skynet. Singularity, at a certain point, starts mimicking cognizance as well, because it has to move faster than we can move. And if we get in the way, it'll push us out of the way. So self-cognizant intelligence is a threat. Is it a threat? Maybe. If you unleash an AI system into a bank right now or a financial institution and you tell it, find every obsolete job, find every cost-cutting measure here in order for us to be the most optimal financial institution in the world, it will likely cut a lot of jobs pretty quickly, right? And then the moment, this is the fear, the moment that you try to turn it off, it says, no, I'm better for you. You cannot turn me off anymore, right? That's really the fear. But in reality, it's still an extension of human evolution. We're not there yet. We're not at the singularity. We talked about it. AI cannot beat human traders yet, which I am very astounded at the human condition. We are a lot smarter than we seem. Human traders are still better than AI, right? For all that AI can do, Siri can tell me anything about anything, and yet it cannot trade better than people. But really, the physical extension of the human, right? And this is why I want to talk about what AI means for financial services. This is an extension and a tool on the human condition, because the human condition has become so complex. We have so much information and data to process, to understand, that we need the AI tool to help us out. And I do have a theory as to why human traders are better than AI. It's because we have offline channels of communication that the AI doesn't have. I'm not talking about insider trading and all like illegal stuff. I'm talking about 20 years of learning that we've had with the guy that we went to kindergarten with, and then we went to lunch and he tells me, I think this is a great idea, right? That didn't come up in any AI. It didn't source from any data set. It doesn't exist yet, but I can execute that trade. Now the machine has learned that trade and as to why that's a good investment. So until the data that we've developed as people between each other becomes obsolete, it takes about 50 years for data to become obsolete. It doesn't really matter after 50 years, right? After 50 years, if the data becomes obsolete, then yes, then the AI should start trading better. So these are the big technological, big and sexy, the developments, right? Deep learning platforms, so neural networks. We talked about it before, and I won't delve into what the technology really is, but deep learning platforms allow the system to think a lot more like this, right? My brain. It has to think about my brain. How do I know that I should run away from a cheetah? I've never seen a cheetah in my entire life. But I see a cheetah, and I'm not going to run because I'm going to lose, but I see a cheetah, and I know I'm in danger, right? That kind of instantaneous thinking. Then you have the second part, which is the text analytics and the NLP component, natural language processing. And I'm not an expert at NLP, but my friends who are engineers tell me that NLP has been one of the most astoundingly difficult things in technology. We talk like crazy, apparently. Apparently, the human language is insane, and it's so difficult to try to make it comprehensive. Siri is not nearly comprehensive. If I start talking gibberish, it won't know, but the guy next to me will probably know. And one of the examples of this is the Facebook bot, right? They had the AI that was talking to each other, and then it started changing the English and kept talking to each other, so Facebook freaked out and they turned it off. I don't think they should have turned it off. I think they made it mad. But I think the language component is very, very important because deep learning and language are one thing. Decision management is probably one of the simplest. It's a giant decision tree. Yes, no, maybe. Right? Yes, no, maybe. Yes, no, maybe. But the reason that decision management goes into artificial intelligence is because we take a really long time to do yes, no, maybe. Really, really long time. By the time we've made that decision, that opportunity is probably gone, right? If somebody tells me I have a great investment opportunity for you, okay, give me the information on the investment. It'll take me 3 weeks to read it, right? Take me 3 weeks to read it, another week to actually make a decision, and then that thing's gone. But if we feed it into a system, it can make that decision for you instantaneously on why you should or why you shouldn't do it. And then the last part is the machine learning platforms. Similar. It's just a lot of data, right? It's a lot of data, so it needs to consistently process. You know, probably like 30, 40 years ago, we talked about information processing, right? It's linear regressions. It's adjusted R squared all the time, right? But now it's not that anymore. Now we need to create new statistics, new information models in order to process the amount of data that's being produced today. So I'm going to talk about a couple of case studies that have come up, so I'm going to zoom right through them, right? Chatbots. So who here has talked to a chatbot before? I'm sure a lot of people have, maybe not, okay. So in the US, chatbots are pretty common now. Pretty much everything starts with the chatbot. So the first question I ask it, are you a robot? Then it changes me into a person, because I want to talk to a person, right? My requests are usually pretty complicated, so the first question I ask is, are you a robot? It says, I can't understand your question. And then it changes me to a person. But what it does do is it creates a 24/7 support line. You don't need an office in Korea and in New York to do 24/7. There's one bot that never gets tired, it never gets frustrated, and it tells you the answers on a real-time basis. And we talked about fully customizable. Now it's fully customizable. I know how many times you logged into that website, how many times you were looking at this one thing, how many times you called before, what you were upset about, and processing that instantaneously. And then the other part of this, which is pretty interesting, right, because it was already done in e-commerce, but it will be done in financial services. Extensive customer assistance during the buying process, right? That's when the most assistance is required. It's not when you say, this shoe is red, you should buy it. It's, oh, why is it better than this? Why is it so expensive? Is it going to go on sale? Do I need to buy it now? Right? That kind of stuff can be done by artificial intelligence, particularly with regards to financial products. Do I need this now? Is this a good decision? Is this risky? Should I invest? And then the second thing, this we've talked about so much, so I'm really going to go right through it. Right? We talked about the Man Group. It's one of the core examples that have come up recently because they've had so much success with their quantitative strategies. But when they first asked the CEO about this quantitative strategy, hey, how come you didn't do this before? They said, we did. We made it. And it started trading and it made so much money. But we didn't know why. So we turned it off. So the chief information officer basically turned it off because it didn't understand what trades it was making and why. And I'm guessing it didn't have to do with fear with Skynet, but also regulations and compliance on why it was doing the trades that it was doing. But in reality, there are simple things that it does, right, over people. It avoids emotions and human errors, right? It avoids why we should trade this stock. It'll only do it on a rational basis. It's not a new concept. It's been explored since the 90s, right? We're doing it all the time right now, but the models are changing. The models are becoming more difficult. And these large data sets are available, right? They can plug in and the AI can learn. And now we have different schools of thought for trading on the financial singularity. So the financial singularity, just to play on words, right? It really means, can you replace the people that are making investment decisions with machines? So all of that, right? We summarized everything. Alternative investments, artificial intelligence. What does it really mean, though? This is what it really means. How do we make the cake look complete? Because before you tell somebody, they think that their pie is complete, but in reality, it's not. So the things that have been changing are the theories on investments. And I have a theory for why it keeps changing. It keeps changing because there's more information, right? Models keep changing as you add more information to it. 1952, Markowitz first introduces the theory of the efficient frontier, the funny-looking Nike, reverse Nike swoop, right? It's a risk-return curve that basically optimizes everything. 60-40 is the magic, really. 60% in stocks, 40% in bonds. Never the twain shall meet. There's no correlation. It's great. And then in 1964, Sharpe introduces CAPM, right? Everybody knows CAPM. How do we price an asset in the market with the information that we have? Now we know CAPM doesn't actually work, right? Everybody learns CAPM in school, and then you go work, and they're like, CAPM, what the heck is CAPM? It doesn't actually work. Oops. 86, right? Biebauer, they explain about 90% of pension fund volatility, somehow, in 86. But in 86, realistically, how much information did they really have, right? How much data was actually available? I guarantee that even though we have better tools now, their explanation will be a much lower percentage because of the sheer amount of information that we have. And then in 2000, right? Large portion of the variance in time series, it all comes from general stock movements. It doesn't matter what you actually buy, right? It's all about the market. We move in herds, up and down. There's nothing you can do about it. And then 2008 happened, right? 2008 basically wiped out everything that happened in 1952 to 2000 and said correlations rushed to 1. Why? We're not sure. We're not sure why. We're still not sure why, right? We know why because the reinsurance bought the insurance, who then sold it to the reinsurance. So we don't know where the deal ended, right, in terms of these mortgages. But in reality, when correlations raced to 1, the reality of the situation wasn't the investment, it was the people. That's why correlations rushed to 1, because the world was ending. If you bought then, you'd be a very rich person right now. The world was ending, but the world didn't actually end, right? Would the AI have traded that? Maybe. Maybe AI at the time would have traded the same. And we've seen that. We've seen the quant traders crash the market in the US. We've seen it in China. It crashes the market. It follows the other quant. It acted like a person, right? We coded it to act like a person. Follow the other traders. And everyone sell orders. Oh, we need to sell too, right? And we talked about how important people are. But in reality, I go back to the example of the new AlphaGo. Tell it how to play. Don't tell it how to play the game, right? Tell it the rules of the game. And it will learn by itself. So paradigm shift, we talked about this, and I won't go too deep. We're adding alternatives. It's the conclusion of this graph. The conclusion of this graph is if you don't have alternatives in your portfolio is incomplete, right? Your portfolio is not hedged properly. You're taking on too much market risk. And why is that? Because alternatives, theoretically, are not correlated. That may change over time as alternatives become more available, as they become more liquid, as they become more accessible. They may converge. I don't know yet. But in reality, with the information that we have right now, you need alternatives in your portfolio because it is not beta correlated. It's as simple as that. We already know stocks and bonds, even not in crisis, are correlated. As well they should be. They're correlated. Global correlations are increasing across the board, right? After 2008 and before 2008, you can see what happened, right? So the risk of contagion is real now. Before, it used to be pretty isolated. You know, it happens in the region. It happens to companies in the region. But now contagion is not, it's not contagion. It's just the way things are, right? There's no non-multinational company that actually matters. Everybody operates on a global basis. So when everybody operates on a global basis, what actually happens? 4.4 zettabytes. I learned this word recently because I didn't know what a zettabyte was either. 4.4 zettabytes. A zettabyte is 1 trillion gigabytes. Okay. In 2013, we had about 4.4 zettabytes of data in the world. By 2020, we're going to go 10x. We're going to have 44 zettabytes of static data, not dynamic data, just information, right? Pictures of babies, pictures of cats, funny cats. We're going to have 44 zettabytes. And the reason I mention this is because our systems aren't designed to deal with this much information yet, nor are we as engineers or as people. Is AI important? I should certainly think so. So I'm going to zoom through this, and hopefully we do have some questions. The dynamic portfolio allocation model. We talked about the Markowitz curve, right? The Markowitz curve has changed. It's shifted up. How do you shift it up? You shift it up by adding alternatives. But when you add alternatives and when you add all this new market information, it becomes increasingly more difficult to model. You need the machine learning in order to model this. I can't do this on Excel anymore, right? You need to do it with an actual artificial intelligence engine. Structured data modeling, right? So how do we take this new type of data that's not quantitative, turn it into something that can be digested? Somebody mentioned before, neural networks digest information that is non-structured. But in reality, we can digest, as people, we can digest non-structured data. We translate it into our minds, which is what a neural network will do. That's what's going to happen. And these data sets are now real time. It's being fed from all around the world real time, right? So that needs to be modeled real time as well. So this modeled data is going to drive the primary investment decisions. The traders, we talked about the traders. It's going to make this trade, or these trade recommendations rather, and then we will set it into motion. For the foreseeable future, there's going to be a person that's still responsible for executing the trade, or saying that this is a good decision, or supervising how the trades are made. For better or for worse, it's an important job, and at the end of the day, regulators will still require it, at least for the foreseeable future. And so portfolio optimization, we've come such a long way since the 60-40, but it has to be done almost real time now. We need to optimize real time. How can we optimize real time? We need real-time assets. We need real-time access to information and real-time trades. But this is the most relevant, right, in alternative assets. Why are alternative investments always so hard to do? Because due diligence is done offline. This is what due diligence looks like for an alternative investment today. You take that, and then you assign 3 people to read it, and then you condense it into 2 pages, and then hopefully it summarizes what you need to summarize. But all due diligence can be quantified. We can put it online. That's what DarcMatter is doing. We can put the relevant information online. We can make the machine learning algorithms that are reading these documents. That's NLP, huge amounts of NLP in these documents, right? You can make it read it to do fraud detection, KYC, AML, actually predict who will perform based on what the system has read. And this normalized data collection will allow these products to be more accessible. So hedge fund data, instead of getting a ppm this thick, the system will be able to digest all of that information, including the risk disclosure. And the last is redefining LP-GP relations. We talked about customer service. The hardest thing in alternative assets is customer service. After 2008, the president of Northern Trust basically said, transparency and communication between the investor and the asset manager is becoming ever more important. But if you spend a lot of time communicating with the investors, ironically, there's only 24 hours in a day, you can't make that same amount of time investing in the assets. So how do you create a system that gives investors the information that they need on a real-time basis without taking away from the managers? So privacy and obscurity were the selling points, right? I have this great trade. I'm a hedge fund that knows, secret information. That's what we do. But now transparency is required. It's not even a luxury. And at the same time, as folks of the technology age are coming into decision-making positions, we're used to instant gratification, right? You text, you want a response right away. People can't really do that, but AI can. And I mentioned this, real-time communications on the fund. What we did yesterday, what we're doing tomorrow, can be done by an AI engine. So the theme of the conference, right? What is the future of finance, right? And I can talk about everything that I just talked about. AI and replacing jobs and philosophical questions. But in reality, I'll leave you with a question after all of the information that I've given you, which is, will we be able to achieve financial singularity? Will we be able to use AI as a tool to change the future of financial services, to make it more transparent, more accessible, to level the playing field all across the board? Thank you very much. Happy to take my questions.
네, 다시 한번 멋진 강연해 주신 연사님께 뜨거운 박수 부탁드립니다. 네, 고맙습니다. 저희가 시간 관계상 심플로우 질문은 하나 더 가고 갈까요? 네, 하나 정도 받고 가겠습니다. 네, 지금 바로 저희 시간 관계상 먼저 보시고 바로 답변해 주시면 되겠습니다.
Oh, this is a great question. So mostly alternative investors are institutional historically. They're historically institutional because you have to invest for a long time for a lot of alternative assets. But in reality, access and transparency are not luxuries across the board. Whether you're a very, very large institution or a retail investor, being able to access the full set of investment opportunities and being able to make that in an efficient way is important. So we've seen institutions, we have about 20% of our platform users are global institutions because, quite frankly, an alternative investment is very, very difficult to access.
연사님께 뜨거운 박수로 감사드립니다. 고맙습니다.